Hey guys, Toby Mathis here, and here's the fact. Your cost segregation study, the one you really thought about, you saw it on TikTok or you talked to your accountant, is gonna fail unless you do these five things. And so I brought the head of a cost seg company, CSA Partners, Chris Streit, in to tell us what is killing these reports, what he's seeing. And by the way, they've done tens of thousands of reports. So welcome, Chris.
Thank you, Toby. Always a pleasure, especially on this topic. I know sometimes it can be a wet blanket, but as long as you've done it right, then you're safe.
All right. Five. Let's nail them. Number
Yeah.
one.
To start, there's one that kind of overarches all, and I would say this isn't even counted because it's table stakes. You got to have a report. You can't just take a deduction for a property that you have. A report is going to be critical. It's going to be your main source of evidence. The five things are going to dive into. Okay, what does that report consist of? But with that report, the first thing that you want to make sure of is your status as a real estate professional or somebody who has short-term rentals and is using the short-term rental loophole, which we've done videos on, Toby, before. If it's imperative that you make sure that status is ironclad and you have the documentation necessary, because those are things the IRS is going to look at and disallow any excess depreciation that's taken and applied against your active income. That's number one. The
Can
next,
I dive into that just
yeah,
for a second? Because I always say there's two lanes. The lane one is what's the deduction that you could, and that's what the cost seg report's going to tell us is how much I could get lost. And then lane two is how do I use it? And so what you're saying is the thing that's going to get you crushed is if you think you can use it, but you can't because you don't actually qualify under the whatever you're trying to do. Like if you're trying to do the short-term rental loophole, you're trying to do the real estate professional status, you're an active participant in real estate. Maybe your income goes up too high, or maybe you just want the loss because you have a whole bunch of other passive income. Make sure you nail that down.
that's key. We've seen that pop up a lot, and that is a big element between the tax preparer and their client. They need to know that you actually are somebody who materially participates in this, and you're not, say, an executive at some other company not doing real estate. If they can sniff that and they ask you to prove it and you can't, then it does nullify a lot of this depreciation.
Well, that's a good number one. What's number two?
Number two, this one starts to get easier. When doing that report, the land value. Land value, we have found, and this has been a recent surge from the IRS, is land value is one of the key things and first things they look at. Now, I have my theories as to why, and the main ones are is that it's an easy test. You can say, hey, there's a very specific guidance on how to approach taking the land value out to determine your depreciable basis, and it is using the time of purchase and using the county valuation and applying that apportionment. If that's not done right, then that's a failure very quickly. And oftentimes it is done wrong. And I say often 80% plus. While that report is a prerequisite to at least start with these five things, that report isn't worth the paper that it's written on if the land value was not done the right way.
All right, let's go over this real quick so people understand. So you can only depreciate the improvement on a piece of property. So if you have a chunk of land and you build a building on it, the only thing that's depreciated is the building, not the land. So we have to back out the land value when you purchase a property so that we can figure out what's the depreciable basis. And then you get a company like CSA Partners to go out there and do their study and say, here's how each of these components, what its useful life is, so we can accelerate that depreciation. So the two ways that I've always looked at is you're either using the county assessor in the ratio of what it's being assessed at. So if it's 20% land, 80% improvement, then I'm going to say, oh, I bought a building for, I don't care what its assessment says, it's those ratios. And then if I bought it for considerably more, I'm still saying 20% of that purchase price is land. Or I do an appraisal and I get the land value from an appraiser. Is that correct thinking or am I off?
No, that's the a correct way of thinking. And even when getting that appraisal, though, you still want to apply the apportionment method, because when you look at the guidance, the apportionment is the direction it goes. So even getting that valuation, applying that against the apportionment towards an apportionment number is how the IRS is going to judge that as a pass fail, because they are, it's public information. We've seen what's happening from a staffing perspective in the IRS, and they still have a requirement to generate revenue for the treasury. And so this is one of those things that doesn't require a lot of, excess thought. You can just look at it and say, did it follow yes or no? So the two things you mentioned are spot on, Toby.
Interesting. But now, what about a condominium? I've seen this where you have no land value. Like you literally, it's the condo, and they say, "Hey, there's no land value in this thing," and you're writing off the whole thing. Is that a thing?
Yeah, there are some properties where there is no land value at all. Think of some of those high rises. You're in, the 14th story, and you don't actually own the land. That's the main building owner who still has that. That is out there. That is available. And those of course usually generate a lot of depreciable basis. I think the key thing folks need to look out there for is there's a lot of providers out there that are intriguing and draw you in with the promise of savings and dollar bills right now, which they're right. But also they don't have the resources to adequately go through these steps to get the land value, and they might just apply 80/20. And you might happen to be in Southern California where land value is exceptionally high, and that exposes you to audit. The key thing is if you see things that are happening that are just quick and easy, and they're almost not even whole numbers, it was just pasted on there, and they're selling that to somebody else to solve the problem in the future.
So, and give people an idea of the breadth of experience you guys have, because you guys do this as a living for accounting firms. Like the big accounting firms are going to come to CSA Partners and say, "Can you do this study for us?" How many of these have you been involved with? How many studies? How many audits? Things like that.
Yeah, so we've done now, just over the last 5 years, we're over 30 to 35,000 studies, somewhere in that range over the last 5 years. So a pretty large amount. We saw the audit environment swing. When you looked in Q4 of 2024, audits were surging up. You might see 7 to 8 in a year out of the volume that we're dealing with. It's roughly 1 to 2% of returns out there being audited. It's not a huge number. Now in Q1 with Department of Government Efficiency, we saw those audits get slashed quickly. We also saw there be furloughs and impacts to staffing within the IRS. But there is still a preponderance of these audits happening specifically for people in real estate who are claiming bonus depreciation, and any type of accelerated depreciation. Where we've put a lot into this to make sure it works is we actually pay for an API for every single benefit analysis, not even engagement, to get the actual land value from the county immediately sent over so we can get the right data and give it to people quick to help inform the decision if this is a good investment for them or not.
Yeah, and again, for folks out there, if your assessment is, "Hey, my building is worth $1 million and the land value is 200,000," right? Okay, that's 20%. If you bought your building for $3 million, because it has nothing to do with the assessed value, we know that, and you use 20%, you're at 600,000, so you have $2.4 million of depreciable basis. You're going to be okay, right? But you should have somebody who actually knows what they're doing look at it, and then it needs to be documented. You need to actually have a report, and you should have somebody actually walk in or looking through the property to ascertain here's what the values are. You do that, you don't need to be nervous. You've covered your bases and you're great. If you aren't doing that, then your risk goes up. And you should be a little nervous because if somebody calls you on it, and then, hey, if you're a real estate professional and you're taking this big deduction and you're like, "Yes, I've offset a whole bunch of my tax," and then you get that audit notice, you're going to feel a little nauseous when you go back and that report was done incorrectly. Penalties and interest, and I have to pay the tax. So it's worse than just having it done right in the beginning. And that's what I always say is do it right in the beginning, then you don't have to worry. All right. So what number was that? Was that 2? Because now we have to get
2.
Yeah. So we need to get to 3.
Yeah, so 3 is ensuring that it is a engineered study, and one of the key variables to observe if you are going down this route is there a site visit? The site visit doesn't need to be physical with an actual body there on the site. It could be a remote site visit, but that site visit is a key element to ensure that it's going in the path of engineered studies. And what I've found is if you're looking at the engineering element and you see a site visit, you're moving to a very high probability that you're going to be in the engineered study. The reason why a lot of folks don't do that is it's expensive. It requires people to do that. It requires training. It requires a technology if they are going to be remote. That engineered component is what helps uphold the the report that is put forward in the deduction taken. Right now, the IRS asks these two questions to start. Substantiate your basis, which is basically asking you to prove the land value. And they say, did you do a site visit? So doing one is one thing. Proving you did one, Toby, you're a lawyer. You know this. Proving you did one is a completely other thing. That's what an engineering study is, and that is critical in maintaining your deduction.
Document the heck out of everything when you do it. Then you don't have to come back 3 years later and try to recreate something or go, I think we walked it. Didn't we do this? And you're like, where's the study? Yeah, get it done ahead of time, and then you can sleep at night. All right. You've hit 3 really good ones. I'm interested in what's number 4.
The next thing is, and we saw this be a relative uptick too, and going back to the site visit and the data and the substantiation that you have for this, we've spent millions and capitalized expenses in technology to make sure we could have that data, capture videos of this, because that data that you get on that site visit corresponds to one other thing. How do you determine the cost of these assets? When you're doing a cost segregation, you are saying, I have physically identified this crown molding here. I can see it. Here's video of it. I have that video. I have a proof. What's the cost that you use to determine that crown molding based on the length of it, based on the type of it? And usually what you see is firms like us and others use the IRS recommended method of RS means, which is a construction software. It's used to determine what it would cost to replace, to build out this type of property. RS means updates every single year. It is incredibly expensive. It also has 970 different local jurisdictions accounted for based on the cost to do certain things. Specifically, an electrician in Phoenix is not the same as an electrician in New York City. Completely different. RS means does all that. The next thing is making sure you have, or the provider you're using has that data somewhere, and it's being sent into the report, and it is up to date, meaning the most recent version, and it is accounting for the local differences. We have seen IDRs, which is an information data request, which comes from the IRS, asking people to prove they use the most recent version of RS means, not a book. It has to be a software embedded into your system, and to unlock all the Excel files to show that you use the file corresponding to the data source of RS means. It's an easy check, and it's a quick pass fail if done wrong.
And so these software programs that are out there, I've seen it, or people are just like using rule of thumb, or they use this is what other properties in the area. That means that all of those are going to fail under audit, right?
They will certainly fail for a couple of reasons. Most of those ones that are producing a report for you almost instantaneously, usually they're having you self-select land value, or they're using some type of automatic percentage, not accounting for anything about your specific property. The second is there's no site visit because it happens instantaneously. And second, it's not actually plugged into a tool like an RS means, which requires a lot of money up front, but also an integration that is not necessarily built in. It's just based on a simple average. So using all of that, you're either going to be giving up a lot of potential deduction because they're playing the odds and shortcutting it, and if they do get audited, then they'll go do a site visit, because it would fail. All 3 of those tests would be fail, 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 fail.
Now, I would say this, that if you're building, you have invoices, you're probably going to be fine, because you could say, here's what the actual cost was. So this would really be for people that are doing a cost seg study that have purchased a property and now they want to accelerate the depreciation on the property they purchased, not because they're building, not because they did a big remodel, but because I got $1 million property and I want to figure out what the land value is and then accelerate depreciation on that improvement value. And I didn't build it, so I have no idea. Is that correct thinking?
That's a great distinction. Those things would be primarily applicable to those not new construction type of things, which you have to go in and identify. The thing I will say for new construction is the actual cost are known, because you do have a detailed budget of that construction. The things that could still be out there for you and a risk element would be some of those first things. Is there a site visit? Some people might say, well, I already have the budget. Why do you do a site visit? Well, because when you go to the site visit, you found that not in the budget is a fountain that was put right in the lobby of this condominium. And that is not accounted for in this budget. Site visit still has to occur for it to be fully engineered. And the land value has a little bit more nuance to it, because think about what a county appraiser might be if there's no improvement. And this is the first improvement on there. There's needs to be a little bit more scrutiny that goes into that land value allocation. So you're absolutely spot on.
And it keeps coming back to this: is make sure you work with a professional. I know that sounds like a broken record, but that's because these facts actually matter. And if you get under audit and you don't have something, they are using the audit guide, and you're using a pass fail, and you're just going to be denied, and you're going to say, wait a second, but I have all these things. And then the last thing is, if you are doing building, keep track of all that stuff, put it aside, make sure it's in a cost seg file, make sure that your cost seg provider has it, so it's part of the report, so that if you're asked to conjure it up 3 or 4 years later, you have it at your fingertips. All right, so that's 4.
Mm-hmm.
What's number 5?
The fifth one is the most important one, where I think a lot of people don't think about it because they say, you know what, there's a 99% chance I'm never going to be audited. I've never been audited before, so it's probably not going to happen to me again. Now, when it does happen, that's when you kind of, you feel very vulnerable. Your back's against the wall. And the fifth thing that you need to have is accessibility. You need someone there, someone to talk to, not a bot.
Mm-hmm.
Not chat GPT even. You could ask it, how do I handle this audit with the IRS? Hey, you should probably have done the study right, is what it's going to say. And I will say this one thing, Toby, as you said it as well. Having done all this right, make sure that the audit goes swimmingly well. And that's so incredibly true. But the reason we're doing this video is because I have found that 9 times out of 10, one, if not all of those things are not done. And the IRS knows it, so they're asking these questions. But accessibility is key. When you get audited, the moment you get that information data request from the IRS, it's asking for information, or sometimes we've found that they've even gone over that step. They just issue a determination. The thing about tax, and this is true at the federal level and at the state and local level, the burden of proof is not on the IRS. The burden of proof is on you, the taxpayer. So they can claim something and they say, you prove us wrong. So determinations are being issued without that, and you need somebody in your corner to help you in the moment that happens, because from the time you start, it is like playing a game of Texas Hold'em almost, is the way I look at it. Is if you're going and bluffing at the start, you're going to make it worse. You want to make sure you have pocket aces when you go into that first conversation. You have guardrails around it. So that's where we, from a firm standpoint, whatever report we do, we stand by it all the way through there and don't charge our clients a dime, and we will attend every single call. And that's not somebody in overseas. That's somebody sitting here in America that's going to be jumping on the call with the IRS and your lawyer and your CPA.
And I'm just going to say as a caveat too, is when you're doing cost seg studies, there's a difference between price and value, right? Price, hey, I could get a report done for free. I could just pick a number, pull it out of a hat, and throw it on a return. Not even do a report, right? There's that range versus, hey, I pay someone to do a professional report. The value difference is, hey, if I'm just picking numbers out of the sky, I'm going to be leaving money on the table. What I've found is that people that use the software or use people that are kind of the deep discount, they don't get the deductions that an actual cost seg study and somebody who does it day in and day out can say definitively, here's the numbers we're going to use. We can back it up, and we want 40% put into 5, 15, 7-year property, and we're going to get a massive deduction, as opposed to, hey, it's 25% ballpark. That extra 15% cost you a ton. And so the price might have been cheaper, but the cost to you was significantly higher. The value wasn't there. So there is a value proposition when you're using somebody who knows what they're doing. And by the way, using somebody who knows what they're doing, CSA Partners, I'll put their link in the show notes. These guys do a great job doing a free analysis of your property. You give them the basic information, and they'll be able to tell you a pretty darn good ballpark of exactly what you'd receive and what the tax savings are. That's why we use them, and that's why I suggest that you reach out to them as well. And they've done tens of thousands of studies over the years. And we do about 10,000 returns here at our shop a year for our clients. We don't pretend like we're doing the cost seg studies. We use an outside firm that's a professional audit, and you should too, if that's something that you're doing. Is cost seg studies are very potent. It can give you huge benefit, but don't go on the cheap, guys. Chris, anything else you want to hit?
One thing on that benefit analysis piece that we do for free for people who are interested in cost seg. Step number 2 in this to make sure you do to protect yourself from audit is the land value allocation. We actually do all of that well before an engagement. So if you want a free land value allocation that's defensible by the IRS, not just a benefit analysis, we have that for you at the website. Toby's going to include a link to. So if you're curious about that, please feel free to input that, and we'd be happy to supply you with that. But also hope we can help you with cost segregation as well, and help you with an audit if it ever happens.
I'm going to put other videos we've done with Chris in the past. I'll put links to those. I'll put them here at the end of the. So go watch one of those, and in the meantime, like and subscribe. It helps our algorithm. Thank you, Chris. Put your comments down below if you have questions of Chris. We'll look at it. We'll make sure you get some, and then we'll answer your questions. If you have comments, just put them down below. Like and subscribe, and I'll see you guys later.
Thanks, Toby.